So I think it's fair to say that the easy money in the stock indices, or the S&P 500, whatever you want to refer to it as, has probably already been made, and that's assuming there is such thing as easy money, of course. We expect quite a bit of volatility going forward. That doesn't necessarily mean that we believe that the highs are in. In fact, we do think the S&P probably has at least one more leg left to the rally. We're looking for roughly 3,000 to 330 in the S&P. In the meantime, though, it's going to be a bumpy ride. When we look at the CNN's Fear and Greed Index, we see a market that has tipped the scales towards greedy. This is the exact opposite of what we saw in December when everybody was fearful. Remember what Warren Buffett always says: be fearful when others are greedy, and greedy when others are fearful. We've been consistently and adamantly bullish equities since late 2018, after the fallout, or around the Christmas time, but we can no longer really justify that stance. We acknowledge that there's a chance, again, as I mentioned, for another leg to the rally, but the risk of being long and wrong is really elevated up here. In other words, the upside profit potential is probably minimal, while the downside risk is pretty substantial. Here's a look at the S&P chart, and you can see that we are obviously not cheap. We were cheap in December as we were testing trendline lows. Now we're not necessarily expensive, but we're far from cheap. In fact, we're wondering if we might put in some sort of triple top. We're not expecting the craziness we saw in December, but we think a mean reversion trade that puts the S&P back into the 2600s, 2650 area is definitely a possibility. If fundamentals flip and things change dramatically, we can't even rule out 2450. That would be testing the trend line support. So that's getting ahead of ourselves a little bit, but I just wanted to point out the possibility. The market's a little overbought, and even after today's pullback, we're still not too far from all-time highs. Unfortunately, we've also been similarly bullish in the agricultural commodities, corn, soybeans, and wheat. Those markets have not fared so well. In fact, they're doing horribly. If you look at a chart that plots both the S&P and the soybean market, you can see that the markets are behaving completely differently when it comes to the trade war situation. The stock market's pricing in almost a best case scenario, while the grain markets, specifically soybeans, are almost pricing in a worst case scenario. So we've got two completely opposite views. In our opinion, they can't both be right, but we believe they're probably both a little wrong. In other words, we think the stock market's probably giving the trade deal a little too much credit. We do think a deal will probably eventually occur, but we're not sure the details are going to be quite as exciting as what the market's pricing in. That said, the grain market's pricing in no deal. They're not going to believe anything until we get pen to paper, and I can't say I blame them. Their short-sightedness is justified. They work on a year-to-year basis. Crops are renewable, so this year's fundamentals has nothing to do with next year's, and so on and so forth. That said, the grain market is probably completely underestimating the ability of some sort of trade deal to come into place. So we're expecting both of these markets to revert somewhere to a more average or natural price level. This might mean in soybeans, let me switch over to the bean chart, sorry. Sorry about that. In soybeans, this could mean 960, 950 area. Honestly, that would be probably just a natural price range. But if fundamentals in beans shift, we could possibly see the $10, $10.30 areas. That's not impossible. We're not necessarily expecting that, but the mid-9s is definitely a possibility, and it could happen sooner rather than later. Of course, only time will tell. In the meantime, if you're interested in speculating in commodities and you want to learn about the risks and the rewards, obviously it's not easy. We're trying to beat the markets, and it's a tough, tough game. But if you're interested in learning more, I recommend our book, Higher Probability Commodity Trading. You can find it in any major book outlet. Amazon's cheapest, free shipping, can't beat that. We also have plenty of free information on our website, decarlitrading.com, so feel free to check it out. There's articles and videos, anything you need to know about trading. And again, we don't sugarcoat anything. It's risky. You may lose a lot of money. You may make a lot of money. That's how this game is played. If there's anything we can do for you, let us know. We are a brokerage service. That's how we make our money. The education is simply because we want our clients to be educated and we want everybody to know what they're getting into before they actually put their money on the line. But if you do decide to trade, we hope you choose us, DeCarli Trading.